A quick show of hands. How many folks out here own real estate? Yeah. How many folks would like to own real estate or wish to own real estate? There's some folks who haven't put their hands up, so I'm wondering why you're here. So REITs essentially sit in that gap, right? Between those who would like to own real estate and those who own real estate. And that gap is there because real estate is a very capital-intensive asset class, right? It requires a lot of money, and any small mistake, unfortunately, can lead to big consequences. And that fear is what leads to people holding off from owning real estate. What REITs enable is greater participation, right? I should be moving this thing on. And what REITs enable is for you to leave others to manage the problems that you would have if you took on real estate investments yourself. We, for some of you might be aware that we recently launched a real estate investment trust. This presentation is not about that. But of course, during the course of that work that we did, we got exposure to what is holding investors back from making investments in REITs. And clearly what is the case is that there's a lack of familiarity. There's a lack of understanding. There's still an understanding gap for investors specifically. Right now, we've heard a lot of panel discussions on policies and on tax implications. But what we also need to try and bridge is the gap on investors being able to evaluate REITs effectively, right? And I think that's why the REITs Association of Kenya and us as professionals in the REIT space have an obligation to really, in order to be able to enhance the market and deliver more REITs, more quality issuances, we have to really focus on providing investor education to the maximum possible so that investors can take an educated conclusion as to which REITs they would like to invest in. So what is a REIT? I mean, we kind of know that it stands for Real Estate Investment Trust, but a REIT is essentially income-producing real estate that has the overlay of a regulated structure, right? You are investing essentially in income, not just buildings, right? A REIT gives you access to real estate that is yielding returns. And therefore, when it comes to the evaluation of real estate, it is the understanding of that income that will enable you to make the right decision, right? You're not meant to be looking at whether the building looks nice or not. It's understanding the robustness of that income, okay? So what does that entail? First, let's talk about direct ownership versus REITs. And that's, again, kind of where we'll start understanding the difference in why you take one route over another, right? When we look at, let's say we've got 1 billion shillings available to us. Some of us might be so lucky, like Jeff. You can acquire one building, right? Or you can go ahead and invest in a fund that has a number of assets, therefore giving you diversification and risk mitigation. However, when you have a building, you face the problem of liquidity. It could be that you face a rainy day, you need some cash, maybe for paying school fees, but you're not able to, dispose of a portion of the building. You either sell the whole thing or you have to keep a hold of it, which means there's a liquidity issue with respect to direct holdings. REITs are typically tradable because you trade in what are known as units. That also then brings about the issue of essentially access, right? Typically, by buying buildings, you take single asset exposure, you're kind of limited to having that one single asset, you kind of put all your money into that one asset, and that means that it's quite a risk as well. That builds the risk. So if anything goes wrong in that one building, you're going to have to take a fairly substantial hit. Whereas in the case of a portfolio, you've got multiple exposure to multiple assets, which means that something going wrong in one asset can hopefully be mitigated by all the other holdings that are there. And then the last thing is that in direct ownership, you manage. Now that can be a problem if we're not professionals, right? If that's not what we do. If we're a doctor or if we're a pension scheme, you don't have necessarily the professionals to manage the real estate, right? In the case of a REIT, you have professionals that do it, right? So Jeff often complains to me that, out of all the 10 apartments that he owns, he'll get calls from his tenants saying, my toilet is broken, can you come and fix it for me, right? You don't have that problem when it's a REIT, but you have the real estate investment, you have the real estate exposure. So why do REITs matter? So real estate is one of the best performing asset classes that one can tap into. But unfortunately, historically, it's been a purview of the very wealthy, right? But that in itself leads to a problem of economic development, because that means that you've got finite capital, because you're only limiting it to a certain few select segment of the population. That means that an affordable housing gap, having better hospitals or more hospitals, having more schools, having data centers, that gap, that demand-supply gap, doesn't get bridged unless you are able to broaden the access to a wider capital base. And that is also the problem that REITs are able to solve. And that's why they are extremely important, like I said, for economic development. How do REITs make money? REITs make money first by raising capital that they then use to acquire assets. Thereafter, they will go and lease. Either you're already acquiring a leased property or you are looking at an opportunity where you can yield it up, lease it up, right? On that basis, you then have to ensure that you maximize operational efficiencies, right? You make sure that the expenses that are incurred in running that building or set of buildings does not erode the income that you're earning from that building. Next, you ensure that you collect. This can be an issue, and again, you need some professionals to help you with kind of making sure that tenants pay on time, tenants pay the amount that they should. And when I say professionals, I'm not talking about sending the heavies around to beat them up or anything. Some of them might do that, Jeff. And then lastly, after you've collected, then the next bit is to distribute whatever you've earned to investors. And that's how everyone then makes money, right? And then once you understand this algorithm or this loop, this is then what enables you to start thinking about how to evaluate REITs. Wait, sorry. Playing around with two equipment. So to think like an investor, I would like to introduce you to a 5-filter framework, right, on how to go about answering these questions, right? Is the cash flow real? Is it growing? Is it safe? And am I paying a fair price? So there are these, sorry, I haven't been clicking as efficiently. So these are the 5 filters that we will look at. We're just about to get into the detail for each one. So there's income quality, balance sheet, asset and portfolio quality, growth, and then lastly, valuations, right? So if we start with income quality first, what do we have? We have funds from operations, right? Out here, typically we refer to it as also net operating income, okay? So you can have fund net operating income or funds from operations. That is calculated as your net income plus depreciation, any other non-cash items, taking away gains from property sale. And it's essentially a reflection of the true earnings power of a building and therefore the REIT itself, right? Then we get into adjusted FFO. The adjusted FFO, you take away the capital expenditure that is required to address the wear and tear of a building. So essentially, it's your take-home pay without deteriorating the value of a building. It is very important to remember that buildings are living, breathing entities, and therefore they need to be taken care of, right? Then lastly is the dividend payout ratio. the dividend payout ratio is not just about you. It's not just for you. Oh, sorry. Again, thank you. The dividend payout ratio is the FFO or AFFO, right, divided by, it's the amount you pay out divided by the AFFO or FFO, right? Now, this is a reflection of not just what are you paying out, which is what is important for investors, but also what is being left in the tank for a rainy day, right? So you have to assess, is a REIT paying out too much, too little, or just about the right amount, right? Because you can imagine paying out too much also has some risks attached to it, right? So income quality is all about understanding if the income is real and sustainable. Next, we move to balance sheet. So here, we've got the loan-to-value ratio. Now, our REIT regulations in Kenya allow up to 35% of debt. And here, I've primarily focused on income REITs because that is the majority of the market. There is a development REIT, but that'll be for another masterclass if I get called back. So we're allowed 35% of asset value in a REIT. And if the economics work, you can actually use leverage to amplify returns. However, the thing to watch out for is that leverage can also amplify mistakes. So you have to strike the right balance. Then we've got the interest coverage ratio, right? This is EBITDA divided by interest expense, okay? It essentially is talking about, your ability to service debt. A 3 to 4 times interest coverage ratio is healthy, manageable, right? But if you're using 50% of your EBITDA to service debt, that means that there could be issues in the future. Cost of debt, like I said before, is essentially about the economics, right? If you're earning, let's say, a 9% yield, but you're paying out debt at 12%, there could be issues. And the fact is, in Africa, it is difficult to work out that debt equation because cost of debt is typically higher. And then lastly, debt maturity. Have you planned the timing of your debt? You don't want suddenly in one specific month or over a period, all your debt becomes due. REITs don't fail because of debt. They fail because it has been timed badly. Yeah? Next is asset and portfolio quality. So vacancy or occupancy, right? Vacancy is the silent killer of REIT returns because it slowly dwindles the earnings potential of the asset. This was a statistic that we used to speak a lot about when we were doing our roadshow, which is the weighted average lease expiry term, something that many investors weren't familiar with. Because essentially, it highlights what is the remaining average lease term that is there in the portfolio across all your tenants, right? This is a reflection of when you're coming in as an investor, how much runway do you have to expect further returns, further rental income from the REIT, right? The longer it is, that means you have greater security, right? So we'll get to some examples of what that looks like. Next, we look at the tenants, right? When you go for a loan to a bank, they will try to understand the robustness of your balance sheet, right? What you're earning, what your wealth is, can you afford this loan, will you be able to pay it back? So in a way, the same analysis needs to be done about tenants. You focus on the tenant's creditworthiness, right? Is it a startup? Is it a company that's been around for a while? What does its balance sheet look like? Is it in a sector that is thriving or deteriorating, right? You need to make all these assessments before you go ahead and make any sort of lease commitment to anyone. And then lastly, sector and location. We've spoken about this. There's different types of asset classes. You can have a retail REIT, an office REIT, a residential REIT, an industrial REIT, and or sometimes you can have multi-strategy REITs. And the benefit there is that you basically take a call then on what your assessment or your view is of that specific sector. And if you don't like, let's say, industrial, then you don't invest in the industrial REIT. It's as simple as that. Next, we look at growth. So what is the difference between investing in REITs versus fixed income, which for those who have come from overseas, the one thing you should be aware of are institutional investors love fixed income, especially what's issued by the government. So fixed income is, yes, risk-free investment, safer investment, whatever you want to call it, but it has a depreciating characteristic to it, right? Inflation erodes essentially the value of fixed income. Whereas as far as real estate is concerned, real estate is considered a hedge to inflation, right? Because typically if you've got long-term lease contracts, you're able to escalate rents year on year. That enables you to counter the impact of inflation, right? Here we've shown, Here we've shown a couple of examples. I didn't, by the way, that was a fluke, huh? I'd already prepared this presentation. But here we've got, for instance, we're showing the metrics like FFO growth per share, NAV growth, rental growth, lease reversion, right? These are all things you want to look at in terms of what is the growth potential. Now, in the case of American Tower, if you don't mind me speaking about yourself, you've seen essentially, it's an infra-focused fund. We've charted out the FFO per share over the last 5 years. My understanding is for the first, let's say, since 2020 to 2022, we were dealing with a rollout of 5G. There was much more demand. You were also looking at an international expansion. And then 2023 onwards, whilst it might look like, the bars are a little lower, actually what I see is a stabilization after a period of strong growth, right? And that's very important to bear in mind, because the quality of a REIT should not be assessed only on the fact that the FFO always goes up, but that it compounds over an economic cycle, because you want that predictability, right? So to me, when I look at the American Tower FFO per share, I actually see a stabilized REIT performance versus not necessarily needing to see an upward trajectory forever, which is also fairly difficult to manage, just realistically. Last is the valuation, and this is where the true professionals stand out, right? Are you able to understand if a REIT is undervalued or overvalued, right? Where is the opportunity? A REIT can be a good buying opportunity because maybe it's trading at a discount to NAV, but you have to understand, is that because the market is missing something fundamental, right? Or is the market actually telling you that we've got some doubts on the sustainability of their income, on the sustainability or the robustness of their balance sheet, right? Sometimes the market doesn't necessarily miss something. We're not all geniuses, right? And that's something to be bearing in mind. So we've shown an example here, Cousins Properties. This is a regional REIT in the US focused on office investment. You can see that the P to FFO ratio, so P, price to FFO, is like a reflection of price to earnings for those that invest in stocks. You can see that that's gradually depreciating over time. What is that a reflection of? The fact is, if you look at the years, it was essentially a reflection of the reduction in office demand as people started working virtually, as they moved to work from home policies. Therefore, this tells you that just because there's let's say an 8.4 times multiple at the end, doesn't necessarily mean that it's a good buying opportunity, right? So some class participation. I'm going to show you examples of 2 REITs. These may or may not be based on actual examples, but I will not tell you who they are. Okay? And we're going to see how they are performing. And by show of hands, we can see who wants to invest in which one, right? So these are the stats, right? And I want to see if people have been paying attention or if some of you, like Brian, have been going to sleep. I caught you there, Brian. Who would invest in REIT A? Okay, who would invest in REIT B? Some of you still don't want to invest in REITs. Okay, so this is clearly a class that hasn't worked. So I agree with those that didn't want to invest in REIT A, and I agree with those that invested in REIT B, because high yield, I mean, sometimes, you can see the 11% and you're like, yeah, that's what I want to do. I want to make more money, right? But high yield is often where risk is hiding, okay? REIT A is paying you today, but REIT B is protecting you tomorrow, right? If you look at the leverage that is there in REIT B, if you look at the occupancy, it tells you that REIT B is the one to go for. And the thing to note is, I say this a few times and I'll repeat it again. REITs are a lazy man's investment, right? Because you're meant to just put your money in and just basically hang back. You're not meant to be actively managing it. It's meant to give you a predictable coupon that is obviously structured around real estate as opposed to fixed income. And that's what REITs are about. They're also a lazy man's investment because women aren't lazy. So, okay. Now let's look at some just global case studies. I'll just speak a little to some of them. I think this kind of gives you a sense of where we can head to as Kenya and East Africa and Africa as a whole, right? When we heard earlier about kind of the corporatization, the institutionalization of REITs, that is what, in a way, to me, this table speaks to. Because you look at the examples, right? You see the markets that are here. You've got representation from all across the world. And these are fabulous REITs that are offering you exposure to student accommodation, that are offering you exposure to offices in India, that are offering you exposure to retail, for those that might be interested. Or there's even Growth Point there, which is South Africa based, right? But you can see, and obviously they've been at it for a while. Most of these are fairly long established REITs. There are many other great ones, but you can see some common trends, I would say. There is increasingly, I would say, a move towards lowering the payout ratio and not being too aggressive with it, leaving some reserves in the tank for a rainy day. You can see that leverage. Okay, these are developed markets, and some emerging markets, but generally sticking to around 20 to 30%. Okay, that to me is a reasonable leverage level. Again, contingent on the fact that if you can make the economics work. This is and the whale as well, right? We spoke about. To me, that's a very critical statistic that a lot of folks don't kind of quite grasp just yet in this market. You've got typically 3 to 5 years is an ideal, or let's call it the minimum whale that you want to see, right? You can have longer, but if you have an investment opportunity with 3 to 5 years whale, that's a strong investment REIT prospect. Now, there's one column that is missing out here, and this is maybe just a personal sidebar that we'll take just from my perspective. Right? So I've launched, 3 REITs along with some of my team members that are here. And my number one competitor is not anyone here. And none of these guys also have had to compete with what is our competition in Kenya. What is the number one competitor that we face? Government, right? We still have that struggle. Even now, in the last 12 months, as we've been fundraising, the number of meetings, we're looking at a yield which is now, 8% or something? And we'd be like, but how can you compete with the government? I do not believe that the government is going to borrow to the hilt in order to provide investors sufficient fixed income so that they don't need to worry about looking at anything else, right? We need to open our horizons and look at alternatives, such as REITs in particular, to be able to offer us different types of opportunities that we can invest in that then provide the return to our funds, schemes, whatever it is. But until we get past, that hump, for those of us who are in this audience who are looking to issue a REIT, be prepared to answer the question: how are you going to solve against what the risk-free rate is. So that's just, like I said, a personal sidebar. I have actually achieved my time.